Welcome to the 54th session on IBC, under which we are learning the liquidation process. In the previous session, that is session number 53, we have covered IBBI regulations, starting with Regulation 32A, which is speaking about sale as a going concern, or otherwise it can be sold in fragments. Then Regulation 32B speaks about meetings of the consultation committee. 33 speaks about mode of sale. 34 we have covered, said asset memorandum, how do you prepare asset memorandum and file it with the adjudicating authorities. Then Regulation 35 we discussed that it deals with the valuation of assets to be sold, and we said that there are different kinds of assets for which different kinds of valuers should be appointed. Regulation 36 talks about asset sale report to be furnished. 37 talks about realization of security interest by secured creditor. 37A deals with assignment of assets not realizable. And then lastly we covered two important regulations, that is distribution of unsold assets and recovery of monies due, which we stopped at Regulation 39. So in today's session, we will learn the residuary regulations of the IBBI dealing with the liquidation process, starting with Regulation 40. So Regulation 40 talks about liquidator's responsibility to realize the uncalled capital or unpaid capital. First, let's understand what is an uncalled capital. Usually the face value of the shares is 10 rupees per share. So whenever somebody is buying the shares from the company, they should pay 10 rupees per share. When they pay the full 10 rupees, it is called as fully paid share. However, sometimes the companies may not take the full money upfront at the time of purchase of shares. So the company will say 10 rupees is the face value, but please pay me only 5 rupees now. So the shareholder or the applicant will pay 5 rupees and buy those shares. So he is still to pay 5 rupees to the company. This amount of 5 rupees which is yet to pay to the company is called as an unpaid capital or uncalled capital. However, there is a slight difference between uncalled and unpaid capital. Let's learn these two terms also. Uncalled capital is where the company does not call you to pay the money. Like I said, the company has only asked you to pay 5 rupees against a 10 rupees share, and 5 rupees it thought it will collect later. So the 5 rupees which is already called is called as a called up capital, and the 5 rupees which is not called will be called as an uncalled capital. However, when the company makes a call to pay the balance money of 5 rupees, some people may pay the money and some people may not. So those who pay the money will have fully paid shares in their hands, and those who did not pay the money will have only partly paid shares in their hand. But however, the company had already made a call, and hence such shares or such money which is to be paid by the shareholder to the company after making a call, such money, if it is not paid, will be called as an unpaid capital. Right? Call made and not paid. Hence it is called as unpaid capital. However, in the earlier case, when the company itself does not make a call, it is called as uncalled capital. As far as liquidation is concerned, Regulation 40 says any money that is left unpaid or uncalled by the company before this liquidation process should now be collected by the liquidator or realized by the liquidator. That's the requirement of Regulation 40. So let's quickly look at the two sub-regulations. Regulation 40 sub-regulation 1 says that the liquidator shall realize amount due from contributory to the corporate debtor. The word contributory here would mean, in this context, simply shareholder who has to contribute to the company's assets at the time of liquidation. And part 2, that is 40, sub-regulation 2 says, notwithstanding any charge or encumbrance on the uncalled capital of the corporate debtor, the liquidator shall be entitled to call and realize the uncalled capital of the corporate debtor and to collect the arrears, if any, due on calls made prior to the liquidation. So what we are saying is, though there can be certain charges, encumbrances created on such unpaid or uncalled capital, liquidator will have primary right over that uncalled or unpaid capital to recover that money. Hence, he need not wait for any more clearances, and any such encumbrances will not stand against a liquidator's right to sell these assets. This is a very critical point. Moving forward, Regulation 40 further says that how does he recover this call money? The procedure of recovery is mentioned in Regulation 40, Sub-Regulation 3 or Sub-Regulation 2 itself. He may do so by providing a notice to the contributory to make the payments within 15 days from the date of receipt of the notice, but shall hold all monies so realized subject to the rights, if any, of the holder of any such encumbrance or charge. So what we are saying is, as far as realization of money is concerned, the liquidator will receive the full money which is uncalled or unpaid, but however, unless the rights of charge holders or encumbrance holders are settled fully, the liquidator will not have authority to utilize the full money. Therefore, he has to hold the money for himself as a liquidator, also as a trustee for all other encumbrance holders who are like charge holders. Now, Sub-Regulation 3 says, no distribution shall be made to a contributory unless he makes his contribution to the uncalled or unpaid capital as required in the constitutional documents of the corporate debtor. This is an interesting situation where after the realization of assets and the realization of uncalled unpaid capital, the assets are sold by the liquidator and monies are paid to the creditors. After that, if there is any surplus left out with the liquidator, such surplus can be distributed to the equity shareholders or other contributories. But here, what we are trying to say is, wherever a contributory is not making his end of contribution, then he cannot receive anything from the liquidator. Liquidator is bound to withhold the disbursal of such benefits to the contributory in case he has not made his contribution to the liquidation proceedings, especially the uncalled or unpaid capital after being called. As we recall, within 15 days of liquidator's notice, we should make the payment to the liquidator of any unpaid or uncalled amount. However, for the purpose of this chapter and Schedule 1, assets include an asset, all assets, a set of assets or a parcel of assets as the case may be, which are being sold, and hence there is no specific definition to the assets here. It can be a bunch of assets, it can be all of the assets, it can be one asset, it can be actually a parcel of assets together that can be called as assets of the company. Now we come to Regulation 41. All money to be paid into bank account. So, a liquidator who is collecting various amounts of monies due to the corporate debtor from different parties, he cannot collect these monies and keep them in his hand. He has to deposit them into a bank and collect them into the bank. The logic is very simple. Let's understand that liquidation of large companies which involve enormous value of assets is subject to a lot of pilferage and also a lot of malpractices that can happen. So, when a liquidator sells hundreds of crores worth of assets to outsiders, he brings this money into his custody. Assume that there is crores of rupees of cash left in the liquidator's room or at home or his office. enormous number of manipulations can happen and the monies can be actually pilfered. Hence what we are saying is, to keep it transparent, to keep it safe and to keep it accountable, the liquidator shall collect and deposit all these monies into a bank account, and from there only he will spend every rupee for the purpose of liquidation, again through a normal banking channel only. He is not allowed to use cash except to the extent of rupees 5,000. Anything above 5,000 rupees he cannot spend cash. He has to write a check and spend it officially through a banking channel. But small amounts which are less than 5,000 rupees, he may use cash. So the whole reason why this regulation 41 is in place is to ensure that malpractices surrounding the pilferage of money from the liquidation account should not happen. Hence, to prevent them, we are saying banking channel is a safe channel where you put the money and start utilizing from there. Regulation 41 further says there are two important points here. Please observe carefully. The first part says liquidator may maintain a cash of 1 lakh rupees. So what we are saying is, if the liquidator has collected a sum total of 5 crores from different sources as a liquidator, then he shall immediately deposit all this money in the bank account. However, if he feels that there is certain cash that is immediately required for petty expenses, then he may keep rupees 1 lakh with him as cash and the rest of the money should go to the bank account. And further, as I said before, all payments which are to be made out of the liquidator's account, which are more than 5,000 in amount, shall be made by checks drawn online or through online banking transactions against the bank account. So let's repeat. The payments out of the account by the liquidator, which are in excess of rupees 5,000, shall be made by checks drawn or through online banking transactions against the bank account only, and hence there is no more cash dealing by the liquidator with any third party, either in terms of receipt of money or in terms of payment of money. Regulation 42 talks about distribution. The moment I say distribution, I am sure all of you have recalled those provisions that we have read under section 53 of the IBC, which is dealing with the waterfall mechanism, where we read how the money realized should be distributed to the various creditors on priority basis. That is section 53, and regulation 42 also deals with that and incidentally connects the payment or distribution to section 53. However, what it says is, subject to the provisions of section 53, the liquidator shall not, let's observe that word carefully, which is underlined in red, the liquidator shall not commence distribution before the list of stakeholders and the asset memorandum has been filed with the adjudicating authority. So there are two requirements. Number one, you should file the list of stakeholders and the asset memorandum with the adjudicating authority as a liquidator. So unless you have fulfilled these two responsibilities, you have no right to actually distribute funds to any party. Shall distribute the proceeds from realization within 90 days from the date of receipt of amount to the stakeholders. So therefore, keeping the 90 days timeline in your mind, you should do all the necessary compliances such as filing the asset memorandum and also stakeholders report within 90 days, and after that only is eligible to actually distribute the funds. But that distribution of funds should happen within 90 days, therefore you should complete the first two steps before the 90 days. The insolvency resolution process costs, which we call as CIRP costs, if any, and the liquidation costs shall be deducted before such distribution is made. Let's understand. While the liquidation and CIRP are being done, liquidators and resolution professionals spend a lot of money and a lot of time on the process. They may not get any money from the creditor. They may spend a lot of money from their own pocket to resolve the issue. However, at the end of the entire process, if these professionals do not get their money back, then it's a very bad scenario for them. Hence, the law itself, along with the regulation, says that all the CIRP costs and the liquidation costs will stand on priority under Section 53 for distribution of funds. After distribution of these monies under CIRP and also under liquidation, only then the balance can be distributed to other creditors. Now we come to Regulation 43, which talks about return of money. What this regulation says is, any person who has received some money unduly, that means a money that you don't deserve to receive, has been paid to you, you've received that money, it is your duty to actually return that money to the liquidator, saying that I don't really deserve this money. Also, while you receive the money, you are not certain whether you deserve the money or not. But later on it became very clear that this money should not have been paid to you. In all those cases, wherever you received money unduly, such money should be returned to the liquidator. That is Regulation 43. Let's come to 44. Regulation 44 talks about very critical timeline, which says completion of liquidation. So the entire process of liquidation shall be completed within a period of 1 year. If you can see the second line on the screen, it is highlighted. From the initiation of liquidation, unless extended by the adjudicating authority for specific reasons. Upon completion, the liquidator shall submit a final report as may have been learning to the adjudicating authority, and upon approval, the corporate debtor shall be dissolved rather. So what we are saying is, the liquidator shall submit a final report to the adjudicating authority that liquidation is completed, monies are distributed, and he will also recommend that the corporate debtor be dissolved. Only when the adjudicating authority approves such application, the corporate debtor will be dissolved. However, point to be noted is, if the liquidator fails to liquidate, please note that at least 25 to 30% of the liquidation cases may not actually be completed within the due time. Most of them cross the time barrier. Maybe some other time I'll explain you why that might happen, but ideally, most of them might cross the timeline of 1 year. You should naturally think of a consequence. If the process is not completed within a period of 1 year, what are the consequences? So what it says is, the liquidator shall make an application to the adjudicating authority to continue such liquidation along with a report which explains the reasons and circumstances under which the liquidation overshot the timeline, and now he will also give an estimate of when is he going to complete the liquidation process. After that, the adjudicating authority, if it is convinced that there are right reasons for extension of time, it may give further time for the liquidator to complete the process. Now, while we are dealing with this, there is also Regulation 44A, which is treatment of avoidance of transactions. We have already studied these aspects, that there are 4 important transactions which can be termed as avoidance transactions. PUFE, we remember those transactions. So how do you treat those transactions during the time of liquidation? What Regulation 44A says is, if any transaction is identified by the liquidator as avoidable under the IBC, such transactions must be treated in accordance with the relevant provisions for avoidance. The liquidator is required to recover assets or value transferred through such avoidable transactions and include them in the liquidation estate for distribution among the creditors. So the asset is recovered, whichever is being sold illegally, unlawfully, or as an avoidance transaction. those monies will now form part of the liquidation estate and that will be distributed to the creditors. That's how avoidance transaction should be treated. Regulation 45 speaks about final report prior to dissolution. The liquidator shall prepare a final report before dissolution of the corporate debtor, outlining the details of process, including the realization of assets, distribution of proceeds, and other relevant actions taken up. The final report must be submitted to the adjudicating authority for approval. Upon approval, the corporate debtor shall be dissolved. This is Regulation 45. Okay, it talks about preservation of records. Preservation of records would mean all the registers, records which have been handed over to the liquidator, like the statutory registers, books of accounts kept by the company, etc., the liquidator shall preserve all records related to the liquidation process, including reports, minutes, and other documents, for a period of 8 good years after the dissolution of the corporate debtor. The records must be maintained in both physical and electronic form and should be made available to stakeholders upon request, subject to the conditions set out in the regulations. However, this is an enormous responsibility on the liquidator. Usually, what do we all do? I mean, if you are looking at an advocate's scenario, an advocate might fight a case with all his heart. But once he lost or won the case, he will hand over all the files to the respective clients and maybe he'll wash off their hands and he will not have any further information with him. Right? But in the case of a liquidator, you are supposed to maintain all the records for a period of 8 years, both in physical and in electronic form. Now, this is an enormous responsibility. Therefore, the liquidator should have a lot of space, the physical space around his office, and also the electronic space where he can have a repository of the data collected during the liquidation process. Let's go to Regulation 46. It talks about corporate liquidation account. The liquidator shall open a corporate liquidation account in the name of corporate debtor, which is designated solely for liquidation process. All receipts and payments related to the liquidation, including asset realization and distribution of the monies to the creditors, shall be transacted only through this account only, so that we understand from the bank statement how much is spent, how much is earned, and who is paid, how much money is absolutely transparently recorded in the bank books. Let's have a quick summary. So what is that we have discussed till now? We spoke about liquidation to realize, liquidator to realize the uncalled capital. That was Regulation 40. 41 says all monies to be deposited into bank account. 42 speaks about distribution of the proceeds. And any person who has unduly received the money shall return the money. That is Regulation 43. Then Regulation 44 says that the liquidation process should be completed within a period of 1 year. Otherwise, the liquidator shall apply for extension of time. 44A talks about how do you deal with the avoidance of transactions. What it says is all the assets which are part of such transactions should be forming part of the liquidation estate. Then there should be a final report prior to dissolution filed by the liquidator, and after that there are residuary regulations which says that the liquidator shall preserve the books of accounts and other records for a period of 8 years, and he must create a liquidation account from which he actually pays monies and receives monies into the bank account. And also there are exclusion of certain assets from liquidation estate, which we have not covered, but if you are willing to maybe read through, you can always read through Regulation 46A, which talks about certain assets that should be excluded from regulation or liquidation estate. So this brings us to the end of 54th session, and then we will catch up soon on 55th session. Thank you.